All right, now we're on limited partnerships, and this is one of my most favorite types of business entities because it's so interesting. It's not necessarily a good business entity, but we're going to learn some of the ways that limited partnerships can be abused and misused, and it's kind of fascinating. I guess that would be more what I mean. It's kind of fascinating how people use business entities for their own purpose, and this is a great example of it. There's much better business entities that we're going to talk about later on, but this is a fascinating one. Okay, so please remember to read the chapter objectives on your own. All right, a limited partnership gets rid of a lot of the issues that we had in a general partnership. If you recall, we have that worry in a general partnership of one partner being responsible for another partner. Now, the limited partners in the limited partnership have limited liability. So there's at least one limited one, but then there's a general partner. So the general partner still has potential for unlimited liability, but the limited partners get that protection. Now, unlike with general partnerships, which remember, and please understand, I'm not saying anything negative about anybody. I'm just using it as a mnemonic. Oompa Loompa, Rupa, Oopa. Okay, so remember under Oopa and Rupa, that was not very well regulated. But now we have Rulpa, and think about it this way, if you will. It's got rule in it, so it means there's a lot of rules. So it's the Revised Uniform Limited Partnership Act, and California is the state that uses that. We've codified it in our California Corporations Code. And so we have lots of rules about limited partnerships. Now, limited partnerships are used for areas of high risk. So real estate investments, wildcat oil drilling, just striking out for oil, cattle ranching, movies, plays, areas of high risk. And it gives that limited liability to that limited partner in the partnership. So it does allow people to invest in a high-risk venture with some limited liability. All right. So typically, how I like to think about it is the general partner is like the director of a movie. He's got this great idea for a movie, or she does, but he has no money. And so he needs producers or limited partners to go ahead and give the money. And the producers know that this is a high-risk venture, knows that there is a lot of liability in making a movie, especially an action movie where there could be injuries. And so they only want to invest if they're limited to losing the amount of their investment. So if they invest $40,000, they can lose $40,000. But they wouldn't lose their home. Now, the general partner doesn't typically mind having unlimited liability because he has no assets. So even if he's sued, they're not going to get a lot of money out of him. All right, so highly regulated. We're going to have a lot of information in both the Certificate of Limited Partnership, which is the public document, and we're also going to have a lot of information in the private document, which is the partner agreement. Again, we file this at the Secretary of State's website for each state that we need it to be filed in. And we got to have the agent for service of process. We talked about that with general partnerships. That's the person or corporation that accepts the lawsuits. We're going to have business addresses of all the general partners, but not the limited. They want to just really contribute money and not have much else to do with the partnership. Also, it will typically state how long the partnership will last so that the limited partners will know when they're going to get their money back. Now, typically you can't have a limited partner's name on the partnership title for the company. All right, the private document, we don't have to have one like we had to have one with the general partnership because RULPA is really going to regulate everything, and we don't need to change that because it's pretty pro the limited partner. But It's going to talk about the purpose of the partnership, like to make a movie, when it's going to end, how much is each partner contributing, what's owned. It's going to be very specific. Think about it this way. It's going to be a bunch of rich people oftentimes, but it could just be an average person investing too, and they want to know when they're going to get their money back. They want to know how much. So it's an investment. If the partnership agreement is silent, then unlike with a general partnership, the limited partners get amount or percent equal to what they put in. So if they put in 10%, they get 10% of the profits or losses. Okay. So typically under RULPA, the general partner is liable and the limited partners are not. But you could change it in the partnership agreement, but that's usually the way people want it. So they're going to leave it like that. And you can read the other bullets of this. All right, financing. So here's a crazy thought, and it'll be interesting to see how this changes under new tax laws. But I have a feeling it's going to be pretty similar. So some people are so rich or even middle class that they need to buy tax deductions. I'm betting that most of you didn't know this. I didn't know this when I first started in law, that people can actually buy and sell tax deductions. That's a little known fact. And so basically, the limited partners invest money, and then they don't care if the movie strikes it big or not, because if they lose money, they get to take a deduction and a tax loss. So they get to basically get to gamble, and the federal government kind of pays for it because the federal government gives them a tax deduction and a tax loss. It's kind of crazy. We're going to do some examples so it'll make more sense. It takes about 3 times of talking about this to really get the concept, because it's really counterintuitive to our common sense of how things should work. We're going to keep talking about it. Don't worry about it. All right, so management. Limited partners cannot really manage too much or they lose their limited liability. But watch the language. The language is key here. And I love to test on this. So they can't manage or else they'll lose their limited liability. But wink, wink, nudge, nudge, they can still be an employee. They can still work for the company. They can still sign loans. They still can go to meetings. They can still view the financial records. They can consult, propose, suggest. But they can't force it. Okay? They can't demand, command, order. But here's the kind of trick to this. I mean, if somebody who's really wealthy recommends, quote unquote, recommends something to you, you're probably going to take their advice because you figure they know what the heck they're talking about. So it's kind of a little bit bothersome that they can be still so involved in the partnership and still have limited liability. Okay, as long as the limited partner acts like a limited partner and doesn't act like a general partner, he gets limited liability. The general partner has unlimited, but again, he usually doesn't have any money, so it doesn't really matter. All right, so we already talked about this. All right, limited liability, they're just supposed to put money in. So if they put in $5,672, they lose that amount. They take it as a tax loss, but then they also are buying tax deductions. So they get a tax deduction that they can take off their personal taxes and pay the U.S. government less money in taxes. So they're actually getting a return on their investment. It's just interesting to think about it. All right, so you can read the continued existence of business and transferability on your own. Profits and losses. Okay, typically, like we talked about before, it's based on how much you put in. So if you put in 5%, you get 5% profits and losses. If you put in 25%, you get 25% profits and losses. So how can they buy a tax deduction? Remember, in partnerships, we have what's known as pass-through taxation. So the partnership files a Form 1065, but it doesn't pay taxes. It does pass-through. So each partner in the partnership files a tax return and pays taxes, or gets those losses to deduct against some other profit that they have. So what are some tax deductions that the partners are buying with their investment that they put in? So let's say a partner puts in $5,000, and then the general partner doesn't need those tax deductions because he doesn't have any money. So he can give tax deductions that have been such as like interest payments, operating expenses such as rent, depreciation, and we're going to have a lot of this still for the next year until the new tax reform changes go into effect. And there'll be some minor changes to what you can deduct, but I bet that these limited partners still get to make deductions. All right, so let's look at an actual example, okay? So we've talked about it 2 or 3 times. Now we're going to look at an example so it starts to make sense. Okay, so what is a limited partner buying when he or she goes ahead and invests in, for example, a movie? Okay, he gets tax deductions, tax losses, and a potential for future profit. So the costs of making a movie are very likely to exceed the value of the film. And in fact, while the movie is being made, it's a loss during the 1 to 3 years that the movie is being made. So let's say somebody invests $42,000. And the movie loses all that money the first year. $51,000 minus $42,000 for the tax loss means that they basically got a tax deduction of $9,000. So this person has other money that they're making a profit on. Maybe they would have had to pay taxes on it. They can take the $9,000 tax deduction from the limited partnership. Maybe it's for rent deduction, and they can deduct it against profits on something else, like another business. So in a way, it's as if they made 120% back, because total they got to deduct $51,000 from their taxes for putting $42,000 in. So you can look at it in one way as if they made 120% back on that 42% investment. Now, obviously with these kinds of numbers, and it doesn't have to be this high, middle-class elderly people often invest in movies. And make sure you look at the Dynamiter example in this week's module so it makes more sense to you. But obviously this kind of money, or at least at the $5,000 mark, which it usually requires, we're talking about middle class to upper middle class. It's a fascinating loophole. All right, termination is something you can read on your own as well. And you should be paying attention to the cases at the end of the chapters or in the middle. Now here's a really great slide to know for purposes of midterm and purposes of exams. Okay? You've got in a general partnership, everyone's a general partner. In a limited, there's a limited and a general. And this is really important to read and understand. In a general partnership, they all have unlimited personal liability under RUPA, unless the agreement states otherwise. In a limited liability partnership, the general partners have unlimited personal liability, but the limited partners do not. They have limited. All right, please make sure that you double check and review that Dynamiter example in this week that's really going to help you understand this concept more. And I'm not saying this is a good thing. I just think it's fascinating how people can figure out how to use the law to their benefit. We're going to talk about much more fair and equitable business organizations later on, and I'm looking forward to that. Bye for now.